We're going to get started today by looking at the S&P 500. You can see that we had a really good year. This is the end of this is the um, last report of the year. We have 24% gain in the S&P 500 this year. That is really good compared to a normal year of maybe 8%. So you can see that the S&P has been above the 150-day moving average basically almost all year. And that is a floor of support. And right now, we have two back-to-back years of 20% gains in the stock market. Um, I don't think we've ever had a 3-year period of 20% gains, 20% gains, 20% gains. So there's a very good chance that we're going to pull back in the next year or not gain as much. We have let me see what else. We're basically halfway between overbought and oversold. We're 500 in our stochastics. So that's we're in the middle of nowhere basically right now. We're above all major moving averages and we're hugging the 50-day moving average. So it looks like we still have momentum in the stock market. But one thing to think about is at the beginning of the year, everything changes. All of the things that worked during the year might not work in the next year. So, and we're very overextended in valuations also. So hold on for a second. So we're overextended in valuations. So we're at the 23 in PE for the stock market right now, the S&P 500. That is really high compared to maybe a 17 average for the past 10 years. So there's room for the stock market to correct and still be within historical valuation metrics. So, um, okay, so let's look at some of our stochastics charts. The S&P 500, you can see that we have a well-defined channel that we've been following for 2 years now. And we're basically right in the middle of the channel right now, and we're 50 stochastics. So we're right in the middle, overbought and oversold in between the channel lines. So we could go up or down and still be within an uptrend. All right. Okay, so I drew up the map of the stock market for the next year, or calendar. You can see the holidays usually are better um, performing times. We have a holiday tomorrow, which is New Year's. We have we have a holiday on the 20th, President's Day. No, Martin Luther King Jr. Birthday. Then we have President's Day in February. So we're expecting kind of a subpar return for the month of February. We also have earnings coming out, and JP Morgan is going to start the earnings in the middle of January. Then we're going to have tech earnings towards the end of January. So that's why I have possibility of green, which is a possibility of going up. And the other things, okay, let's look at our average stock market returns. You can see February is one of the worst months, as is the middle of the year. The June, August, September months are bad. Um, we actually had kind of a flat December. It wasn't a lot to write home about. So we didn't have our normal Santa rally this year. We have, if we look at our, hold on, if we look at the S&P for the last week, you can see we're kind of down 1%. So Santa rallies don't always come around. If they did every year, then we'd all be millionaires. But it's just a tendency, like 80% of the time it happens. So, so everyone at this point in time in the stock market kind of is coming up with their picks for the next year. We're going to go over a couple smart people's picks for the best stocks to pick for next year. And let me see. All right, so let's look at some of our talking points here. Um, we're only at 52% above the 200-day moving average in the stock market in the S&P. That is getting worse. We're kind of losing momentum again. So if we have this week, we actually had down days every day except for today so far. So we're starting to lose a little bit of momentum in the stock market. I wouldn't be surprised if we were down in January, even though it's traditionally a good month. This is the time of the year where we come up with a um, plan for the next year. Our next year is we have to, let me see, our next year plan. Okay, so our next year plan is, we'll go over that later on. Let me see. Okay, we already went over that. Okay, the 10-year Treasury has been going up in a for the past since October. You can see we are in an uptrend, and usually when the Treasury goes up, the stock market goes down. But we have a kind of a correlation right now. As the stock market goes up, um, the U.S. Treasury yield goes up too. So in general, as the U.S. Treasury yield goes up, the demand for stocks and the ability to pay a premium for stocks goes down. Because if you can get a 10% yielding investment that has no risk, why would you want to put your money in the stocks, which have risks? All right, so let's look at the price of oil. Let's look at what it's doing today. The price of oil, it's up 0.75% today. So we expect all the oil and energy companies to be up with that. Um, Natural gas has been on a tear recently. There's been a lot of cold in the United States. It's colder than normal. And because of that, there's a demand for natural gas. So as there's two big factors for natural gas prices. One is the demand for heat in the wintertime and the demand for air conditioning in the summertime. So as the temperatures go down and are less than expected, the natural gas prices go up. So let's look at some more things from our, okay. Okay, inflation is going up a little bit since last week. Last week it was 2.6%. Now it's 2.7%. Um, the price of oil is down. That's going to help inflation a lot because that's a good factor into almost everything that's sold in America. And the US dollar is unchanged, but it has been going up. Let's look at the dollar chart. You can see that it's going up. And our formula for commodity prices, a stronger US dollar tends to drive commodity prices and gold prices lower. So it's kind of a coincidence that dollar index is unchanged and also the gold index is unchanged. So we'd expect if dollar went up, then the gold prices should go down. So now if the dollar continues to go up like this, then there's a good chance that the price of oil will go down and that helps inflation. And that might counter some of the um, tariffs that are going to come with the new administration. Let's look at the fear and greed index. The fear and greed index shows fear right now. It was extreme fear last week. So this is a contrary indicator. So whenever people are fearful, a lot of times it's time to look for something to buy. We can see from the stochastics, we don't have like an oversold situation. So we like to buy whenever everyone's fearful in extreme fear and when it's oversold and everyone is selling. So right now we're right in between. So there's no real good signal. So the American Association of Individual Investors survey says that most investors are still bullish um, by just a little bit compared to bearishness. So that's a contrary indicator. Usually when the amateurs are bullish, it's time to sell a little bit. So the VIX is down to 16 right now. It was 25. So we had extreme fear last week. Usually when there's extreme fear, we have a 25 reading in the VIX. That's the time it's time to start looking to buy. But right now, we're getting back to a normal complacent reading in the VIX. And our emotional graph of emotions were probably right here, fear. Um, and what are we fearful right now of? We have a new administration. We have a lot of geopolitical issues. We don't know what Trump is going to tweet next. There's a lot of uncertainty baked into next year. Um, let's look at some of our things that would lead to a crash. We have all the indications in the world that China is going to invade or do something um, adversarial against Taiwan. So if that happens, there's going to be a huge correction in the stock market. Um, we do see almost every week China is surrounding Taiwan doing military exercises. So it's just almost like how Russia surrounded Ukraine. They said they wouldn't attack them, but they end up doing that. So we have to be ready as investors to adapt to that situation if it happens. Um, okay, so right now we do have a situation where we have 7 or 10 stocks that are basically overvalued. The PE for the Magnificent Seven stocks, they're around 30, and the average stock in the S&P is about 10 to 15 PE. So there's a huge disparity between the top stocks, the largest market cap stocks, and the other stocks. So sometimes when you switch to calendar year, you have a return to the mean. And a lot of times, um, the larger stocks here in this situation might go down to a valuation of 20 times, and the smaller stocks appreciate. We do have a situation where consumer debt is becoming an issue. This week we had credit card delinquencies at all-time high. So we do have the biggest part of the economy, the consumer spends. Se Consumer is about 70% of the economy, and if they stop spending money, then there's going to be a correction in the stock market. So we have to really watch the health of the consumer. Let me see. Okay, so we do have a concern about the Trump administration, what kind of random things that Trump is going to say during his presidency. He already has cabinet picks that are making stocks go up and down, and tariff threats, how that affects all the stocks we're following. And those are the biggest things I'm concerned about. All right, so let's look at, okay. Okay, let's look at our first to worst. Today, we're actually going to start a new first for worst. First to worst. 2025. You can see the sectors that did the best this year. Communication services, IT, communication, okay, consumer discretionary are the best this year in financials, all around 30 or more percent. And the worst have been materials, consumer staples, energy, healthcare, and real estate. Those are basically almost all of them are the ones that did bad last year too. So I'm thinking healthcare and energy could be the new leaders for the next year because we have this administration that favors deregulation and drilling and um, allowing companies to be more profitable, especially drilling oil. So we have energy and we have healthcare companies. Healthcare companies are actually down for multiple years in a row. So last year they were down, they were negative 1% gain. And this year they're basically at 1% gain. So I'm sure Dan Niles would probably be thinking this is another contrarian play that could do well this year. So if we have a lot of potential volatility and unknown, a lot of times people gravitate towards safe sectors during unknown times. So if we have maybe a correction in the general stock market, people will gravitate towards safer um, sectors such as healthcare, energy, or utilities. So let's see what happens next year. And I put together themes for worst for the coming year. Um, there's a saying, "Don't fight the Fed." That means if the Fed is reducing interest rates, you want to be in that trade, meaning you want to buy stocks because that favors stocks. So the Fed is cutting rates, and investors will be reaching for yield in stable businesses because as the rates go down for the 10-year Treasury, we have or the for we have a demand for yield. So utilities, healthcare, and consumer staples, um, even drug companies will do good if the Fed continues to reduce the interest rates. So high yielding investments. Strong dollar is going to be, well, we have a pattern right now where we have a strong dollar. If that continues, we have companies that do business overseas, such as the big tech stocks, they'll be negatively affected, maybe 5 or so% of their money. Um, they won't, they might have 5% less earnings if the dollar continues to appreciate in value. So the input costs of goods from overseas goes down, and um, that helps the American companies because that reduces their cost of goods sold. And the price of commodities should go down if the dollar continues to go up, and that will help inflation. All right. So the other theme is going to be tariffs. What exactly is going to happen regarding tariffs? It could be that there aren't any tariffs or they're very minimal. We could have all these talks of tariffs by the president now. It might be a bargaining tool. We don't know if that actually will happen. Last time, Trump, um, he promised tariffs, but they really didn't happen. So we don't know if that's really going to happen. Deregulation is a theme too. So that should help financials, banks, oil, and crypto. Um, that should allow more IPOs to come to the market. And that's good for Morgan Stanley, Goldman Sachs, and Apollo Management, a lot of the companies that um, have to do with IPOs. And the other themes we have are the Department of Government Efficiency. We might have a loss of government jobs. Um, might have an increase of government automation, disruption of established business models. We don't know what extent, what we might have less defense spending. We don't know exactly what this is going to do, but I think that's going to be a theme. We might have more usage of artificial intelligence in the government. I don't know, but in general, that's going to be something to watch. Um, we're still watching the losers to the winners. So I'm thinking utilities, not utilities. Let's do real estate, mm, healthcare, and energy. Let's look at those two sectors as possible outperformers for next year. And let me see. All right. And the other things to think about are cyber attacks on America. We just had Chinese trying to break into our US Treasury computers this week. So there's a growing need for protection, for cybersecurity protection. And that's not going to go away. And I think the other theme is the AI growth is going to taper. So we had like an amazing amount of growth for the top Magnificent Seven stocks this year. Um, they're projected to grow less next year. So that means we're probably going to be not growing as fast, at least as this year. We probably won't have 30% gains in the tech sector for next year. All right, that's the themes for next year. Let's look at their final sector performance year to date. We see the S&P is up 24%, which is pretty good. That is a really good year. And the worst performing sector is materials sector. Hmm, that could be because the US dollar has been so strong recently. If the dollar goes up, a lot of commodity prices go down. So the interesting thing, Trump actually wants the dollar to depreciate in value. So he actually said that. So that could help the material sector if the dollar does go down and doesn't strengthen anymore. All right, let's look at some of the things going up and down today. Okay, so sectors. Let's look first of all at the price of oil. Okay, you can see it's up 1% today. So all oil stocks are going to kind of be up today. So let's look at that. So we definitely have oil ETF up the most. Um, it could be people are positioning at the end of the year for the next trade for next year. So we outlined just right now, just looking at it, possible trades for next year. And we came up with oil. You can see the Treasury is going down just a little bit. It went down a lot yesterday, but it's been going up. You can see this is an upward trend. So we don't have a really good correlation of interest of, we don't have our yields going up positive for it. That wouldn't work today because it's kind of the interest rate is kind of flat for today. It's not up or down a lot. But let's look at the sector ETFs just for fun anyways. You can see the energy is up a lot because of the price of oil is up today. And let me see. The ones down the most are technology and utilities. Okay. So this is like opposite of what um, our year-to-date chart. So if you look at our year-to-date, okay, first the worst. So if you, this is like an inverse, today's gainers and losers are inverse of this first to worst for the entire year of 2025. So you can see the ones doing the best are opposite the ones that did the worst. And it could be that people are just seeing this chart right here and saying, we're going to try to reposition our portfolios into the ones that did the worst. And for the new year, that very well could be what's happening. I don't know. Okay, let's look at some more. Let's look at some of the stocks going up and down the most. Okay, we have Moderna. They do vaccines. Um, we have mm, there's a lot of oil companies in this top. We have Apache. We have Marathon, we have Valero, Texas Pacific Land Corp, Occidental. Okay, we have a lot of oil. So people are probably front running right now this kind of switch to what worked the worst last year to the best. Moderna, their example of a stock that was crushed when they're talking about um, allowing Robert F. Kennedy Jr. to um, be in charge of the vaccines of the country. The ones doing the worst are the ones that did the best this year. So Axon, these are all ones that performed like over 30, 50% this year for the most part. So we have a lot of profit taking here. Maybe selling, last minute selling before the end of the year, some of the profits. Um, okay, so it is actually the worst. It's total opposite, the worst, the first for this year. All right, that was an interesting thing that happened today. All right, so this is our final look at Dan Now's picks for 2024. You can see his Amazon and Meta were awesome. Amazon's up 45%, Meta's up 68%. We're going to find out what his picks are for next year and we'll follow them. His Texas Instruments didn't do very well this year, 13%. KWeb, the Chinese tech ETF, is only up 11%. And the biotech ETF, XBI, is only up 1%. That was really bad. So we're going to see what he says for next year. He commented a little bit about next year, but he didn't give his picks yet. So we'll look at what he's commented on a little bit later. I picked out a couple charts that were interesting to look at. And okay. And this one right here is, let's see, hold on. This is Altria. They, of course, make cigarettes, but you can see they are at the bottom of their channel. They're in an uptrend here. They are totally oversold at less than 20 in the stochastics. So you can see that they're right at their 150-day moving average. The green line here is the 150, and that's very important. It's held that for a long time. And we do have the good things about Altria. They pay like an 8% or 9% dividend, and we're having lower interest rates. So there's going to be a demand for high yielding investments. So it's going to be really hard in a year to find a 9% investment. Also, let me see. Okay, that's good. So let's look at our next stock to look at. Okay, we have Colgate Palmolive. We have it's a dividend stock. It doesn't grow a whole lot, but you can see it's oversold. It's around 20 in the stochastics, and it's at bottom of its trading range. And you can see the 150-day moving average, the green one up here, is it's lower than its 150-day moving average. So it's kind of lost momentum. It could be starting to go into a sideways pattern here. I'm not sure, but I own it just for a dividend. Let's look at the next stock, Microsoft. We're going to go over some of Dan Ives' picks for next year. One of the picks that Dan Ives thinks is going to be a good performer next year is Microsoft. And I found that they're very near a oversold condition. They're around 26 in stochastics. And you can see that they're right at their 150-day moving average, which is the green line right here. So we have a lot of support. I mean, right here, this is its trading range going back at least a year. And so I would say around 410 is the bottom of their trading range. So they have their headwinds for Microsoft are they're growing in their data center. They have a good source of energy for their AI ambitions now that they took over 3 Mile Island. and they have a diverse revenue stream. So they have Xbox, gaming, they have office productivity, they have AI, they have a data center, very, very diverse um, portfolio of um, things to sell. And actually, the reason why I bought this is back in 2008 when I first bought this. I knew they reinvested into their company more than most companies. So they would basically have a lot of research and development, and I knew they would, constantly be innovating. And so I've held it, through some bad times because I knew that they had a commitment to research. And now it seems like this year and last year, they've had AI as their big um, new product. So so anyway, that's why I own Microsoft. And I'm a holder of the stock. It pays a 1% dividend. So let's look at another stock. You can see Berkshire Hathaway. Um, they're at the bottom of their trading range. A lot of the insurance stocks are down now because of what happened with the shooting of a CEO in another insurance company, and due to possible new administration. But we see the great thing about Berkshire Hathaway for the coming 4 years, they don't, they're not as affected as other companies with tariffs because a lot of what they do is within America. So they have a lot of businesses like Geico and Dairy Queen. A lot of those are American companies, so they don't have to worry about foreign exchange rates or tariffs. And on top of that, you have one of the best investors in the world managing a huge stock portfolio for you. So anyway, they're basically hugging this trend line and right at the 150-day moving average. So whenever there's, um, I think the diversity in the way they make money is a form of safety. So it's one of the safest stocks. If you were to buy one stock and hold it and be safe, this is probably one of the safest stocks that you can buy. All right, let's look at Eli Lilly. I mentioned earlier about how healthcare underperformed this year and in general. And this could be, right now you can see that Eli Lilly is very close to its trend line. And it's halfway between overbought and oversold. So you can see that the great thing about Eli Lilly for the coming year is they are ramping up production of their drug for obesity. And if they can start advertising, and they recently said that they're not in short supply anymore, if they can get that on to the market and sell that and produce enough for people to make, they're going to be a 30% grower for a couple of years, I think. So right now they're just a little bit overvalued, but they're growing at 30%, and I've owned them for a while, and um, it could be a contrarian play for the next year because drugs are totally out of favor right now. Okay, let's look at another one. Costco. Costco is oversold. It's at 20 in the stochastics, and they're at the bottom of their trend line. So they're things that are going good for them. They just raised their prices for their members, and that's so they raised them 10% in general. And on top of that, they're growing their membership, the people that pay for their membership, by 8%. So they're growing 10%, and and they're and they're raising their cost of their membership. The only issue is their PE ratio is very high, so they're very expensive. They're something like 3 times they're trading at 3 times their growth rate. So um, it's one of the stocks that is a it trades at a premium, probably because they're consistently growing at 8% a year. All right. Okay, here's I mentioned that we would go over some of Dan Ives' top 10 winners for the artificial intelligence for the next year. So this article basically talks about how Webb Bush thinks the AI we're in a first inning of a 9 inning baseball game for AI. And he still believes that some of the biggest stocks are going to perform the best in the coming year. So he likes NVIDIA, Microsoft, Palantir, Tesla, Google, Apple, MongoDB, Pegasystems, and Snowflake, Salesforce. And some of these stocks are users of AI, some implement AI. Um, but what I'm going to do is I'm going to keep track of these stocks, how they perform during the year. Sometimes there are huge drops in the stock market and these stocks go down. That could be that could be a time to start buying them. But he says the AI software era is here. So half of these stocks are use software for their AI, such as Salesforce. They do this agent force. You see advertisements for that on TV. So, um, he still believes in AI, and that's his top 10 stocks show that. Um, his biggest pick in 2025 is NVIDIA. Even after over 100% run this year, he thinks their dominance in hardware continues to stand out, and he thinks that it's the only game in town. So we'll start keeping track of this every week now that we have picks from him. I'll try to find some picks from other people to keep track of theirs also, especially Dan Niles. Um, okay, so Dan Ives, he gave the picks for Palantir, NVIDIA, Tesla at the beginning of the year. So he was right on target for last year. He says the important takeaways from this past year are don't throw in the towel when there is a huge issue, like a geopolitical issue. Um, we're we're in a bull run for AI and it's just getting started. He thinks it's going to last 5 to 6 more years. Um, he mentioned that in this article, this video, you can click on it. For every dollar spent in a NVIDIA chip, there's $8 made by the companies that are using it. So he thinks autonomous, which is autonomous driving, like Tesla is making with the robot taxi, he said that's going to be worth $1 trillion alone. And on top of that, he thinks that these robots that Tesla are making is going to be another um, type of product that'll catapult Tesla up to a very good stock. Palantir, he thinks is going to be the next Oracle. He said it's the purest play in the market for AI. He thinks that NVIDIA could be um, a $200 stock, and he thinks Apple can be a $350 stock. Um, but the important thing that he says is there are companies like ServiceNow, Snowflake, and Salesforce that are monetizing from AI right now. So he's big on AI. He's not backing down from that. Um, Dan Niles, I was looking for picks for next year, but he didn't give any. But he did say his prediction is spending will slow down uh, for the um, for the big tech spend on NVIDIA chips. So he says it's going to be mirroring the COVID time when there was a huge spending spree during COVID, and then there was a digestion period where we went down. So he says we're in next year, in the coming year, we're going to be in a digestion phase where companies like Microsoft and Facebook and Amazon aren't spending as much on chips. So, so anyway, he mentioned Dan Niles mentioned that the Mag 7, the big tech stocks are trading for a PE ratio of 30 average. And that's very pricey compared to the rest of the market. He sees it the next year as a return to the mean. So if these tech stocks return to the mean, they're going to have a PE ratio of like 20 or something like that. And that's a lot less than where they're at right now. So he thinks the mid cap to the small to mid cap companies will appreciate more than the big caps will in the coming year. And deregulation will help the small to mid caps more. And let me see. So I'll wait for his picks. As soon as I find him, we'll keep track of his picks for 2025. So, all right. So I did do a screen, and let's pull up the screen just for fun. Okay. So what I did was I just this time I'm looking at stocks as a contrarian. The sectors that are out of favor. Right now we have sectors that are unloved and no one wants them. A lot of the stocks in those sectors are trading at a discount to fair value. And maybe it's because of a good reason or not. We have the drug sector. We have a drug sector. We have companies that do IPOs like Morgan Stanley. We have insurance companies. So, and then we have Chinese companies that are in orange. So, those are the themes that I see here right now, and oil companies. So, those sectors are out of favor right now, and there's a good chance that we'll look back in a year and these stocks that are out of favor now could be the ones that do the best for the next year. So, we have solar companies, the First Solar, we have a lot of sectors that sold off, like insurance companies. Um, I highlighted a couple of these. Let's go over some of them. Eli Lilly. Okay, we can see that it's 20% overvalued according to its PEG ratio. Um, but it's growing. Its return on equity is 65, which is really good. It's growing around 30% a year. They're growing their revenues at 30%. Morgan Stanley, um, they will have they do a lot of IPOs and business for taking companies public. So that will their business will book for that will be doing really good in the next year. And of course, they're a financial company. They're a bank, so a lot of the banks are appreciating with deregulation. So we have Progressive. They're an insurance company. Um, hmm, they don't do health insurance, but they do um, housing and that kind of thing. So we have Uber Technologies. They're out of favor right now. Um, Potential autonomy. They could be using, there's a lot of fear that Waymo and Lyft, a lot of companies that are making automated taxis like robotaxi for Tesla, they might take over their business. So um, let's see if that turns out to be a contrary play for next year. AppLovin is kind of undervalued. Apollo Management, they do IPO. They give money to small companies so they can grow. Um, Travelers, they do a insurance. So you can see that the ones I'm highlighting are like undervalued. You can see the PEG ratios under one. JD.com, they're a Chinese company. Baker Hughes, they're a oil company. Let's look at some more. United Airlines. Okay, I thought it'd be interesting to go over United Airlines because typically airlines don't grow quickly. They're just an unloved sector for people don't pay a whole lot for them. They're traditionally a 5 PE ratio kind of stock. Let's look at United Airlines. You can see that they're expected for the next 2 years to grow around 20%, their earnings. When I look at this chart, this is pretty concerning that they have losses, in these quarters. So the good thing about this company, I guess, is they have a very low price to earnings ratio. So, um, so they start with a very low PE. So it's not going to, it's, let's look at the, okay, let's look at the growth rates. We have a zero, almost 1% from 2023 to 24. So there's not a whole lot of growth from last year to this year. Um, they're growing at 20%, so they're half price, according if these numbers are right. Um, the one problem with this company is during COVID, they had to borrow money to stay um, to continue operations, and so they're still trying to pay that off. They have um, $32 billion market cap, and half of that is in debt. So that's pretty concerning. So as the interest rates go down, then that would help them. Um, so less regulation, that might help them grow. Um, dollar is going up recently, so commodity prices such as oil are are going down, and oil is one of the biggest costs for airlines. So if the price of oil goes down, that really helps their profitability. So if Trump does what he says he would, and he allows um, more permits to be made for drilling oil, the price of oil will go down, and that will help the airline companies. Okay, so negative is earnings are sporadic. So you see this negative. You don't see Microsoft having negative earning quarter. It's kind of flaky. Um, so they were actually nearly wiped out during the government shutdown during the pandemic because they had to borrow money. They couldn't fly their planes. Everything was shut down. So it's a very fragile business model in a situation like that. Um, okay, so let's look at some more numbers from this UAL. The market cap is 32 billion. Let's look at their total cash. If you net the cash from the debt, there's 15 billion in debt. So that's half of the market cap. That is very concerning. The forward PE is only 7.2, 7.8. So we have a return on equity of 27. That's great, but the profit margin is only 5. So I think, um, okay, so this profit margin is probably at the mercy of the price of oil. So if the price of oil goes up, this company is going to be crushed. And because of that, um, it makes earnings unreliable. So for me, a long-term investor, it's hard to predict the price of oil. And because um, so much of the profitability of a company is based on the price of oil, and that's volatile, and they have a lot of debt, I'm going to stay away from this one. All right, that was a good exercise. Okay, now next little news story: drug makers to raise U.S. prices starting January 1st. So they're expecting to grow um, to raise prices by like 5% average for a lot of these major companies. So that could be like one of the things that could help the drug sector. Um, their earnings estimates for the drug makers are going up 20% this year compared to only like maybe this year they went up 5%. So so with the Mag 7 profits decelerating, it was 30%. Now it's only 17% for the next year. Um, we're going to watch the drug sector, see how well it does. Let's see. Okay, we had a news article. The Chinese there was a hack in. Let's look at the front page story of the Yahoo Finance. Okay, let me see. Chinese. Okay, Chinese hackers breach U.S. Treasury Department. Okay, that was a big news for today. So that kind of goes with our theme of cybersecurity being a theme for the next year. Every time that there is a news story that there is a hack of a large company or government, we're going to have an attention. People are going to bid up these cybersecurity stocks. And some say that this is going to be bigger than AI, the cybersecurity spend in America and the world. So we'll keep our eyes on that for the next year. All right. So you see. All right. Well, I hope you enjoyed this talk. I hope you have a brand new year. Um, we had um, if you're following our portfolio returned like 30, over 30% this year, which is really good. I hope you did well also. If you have any questions for me, let me know and I'll research it for next time. I hope you have a really good new year and happy holiday season. All right, we'll talk to you all next time.